Welcome back to the deep dive. If you have been with us for the last 4 sessions, I want you to take a moment right now. Just pause. Take a deep breath. Seriously, do it. You have survived the macroeconomic vision of Viksit Bharat. You've crunched the heavy expenditure numbers. You've waded through the deep sectoral allocations for agriculture and infrastructure, and you're still here. You have effectively run a marathon through the Indian economy.
It really has been a marathon. But you know what they say about marathons? The last mile is often the most important. We have navigated the dreams and the promises, but today is where the rubber meets the road.
That's right. This is the grand finale, part 5 of our Budget 2026 Masterclass series. And while the previous episodes were about where the government spends the money, the shiny schemes, the big bridges, the subsidies, today is about the reality check. Today is part B.
The business end of the speech.
Exactly, the business end. Today is about how they collect the money. It's the tax proposals. It's the direct taxes that hit your paycheck and the indirect taxes that hit your shopping cart.
And usually, I'll be honest with you, this is the part where most people tune out, unless they are chartered accountants or CFOs. It's typically a laundry list of cigarettes got expensive, mobile phones got cheaper, and here is a new cess on coal. It's dry, it's technical.
But this year feels different. I was scrolling through the news feed when the speech was happening, and even I stopped cold when I saw the headlines coming out of Part B.
You absolutely should have stopped, because the finance minister didn't just tweak a few rates or add a surcharge. She dropped what is arguably the headline of the decade for the Indian taxpayer.
You are referring, of course, to the Income Tax Act 2025.
Precisely. We are effectively witnessing the retirement of the old guard. The Income Tax Act of 1961, a piece of legislation that has governed our wallets, our businesses, and our anxieties for 65 years, is finally being replaced.
That is a staggering thought. That law is older than the Beatles. It's older than the internet. It's older than the vast majority of people listening to this right now.
It is. And think about the psychology of that shift. Usually, tax budgets are about squeezing. The narrative is, how can we extract 0.5% more from this sector without them screaming too loud? But the stated intent of this new act isn't just extraction, it's simplification. It's a philosophical pivot from a system designed to catch thieves to a system designed to trust citizens.
Simplification over squeezing. I like that as a headline. But we are the deep dive. We don't just take the government's marketing slogan at face value. We need to verify if it's true or if it's just a new coat of paint on a crumbling wall. So here's our mission for this final masterclass.
We have a clear agenda.
First, we're going to decode this direct tax revolution. What does the new act actually mean for the common man and the corporation? We're going to look at the loopholes they've closed, specifically the share buybacks, and the relief they've offered to the accidental criminals with foreign assets.
Then we move to the indirect taxes. We're going to look at customs duty, where there is a fascinating geopolitical tug-of-war happening between Make in India and the green transition. How do you protect local industry while trying to save the planet?
And finally, because we promised, we're going to do the ultimate cheat sheet.
The rapid-fire revision.
We're going to condense everything. Deficits, schemes, acronyms, the weird terms we've discussed over 5 episodes in, to a mental model you can carry with you. Whether you're a student prepping for the civil services and need to write an exam next week, or an investor looking at long-term strategy, this is the toolkit you need.
Ready to wade through the legalese and find the story underneath?
Let's dive in. We have to start with the big one, the Income Tax Act 2025.
So let's rewind the clock slightly. In July 2024, the finance minister announced a comprehensive review of the Income Tax Act 1961. Now let's be cynical for a second. Governments announce reviews and committees all the time. Usually they result in a 500-page report that sits on a shelf and gathers dust.
Or they result in a few minor amendments that just make things even more complicated.
Exactly. But this time, they actually executed. The review is complete. The Income Tax Act 2025 has been announced. And the date you need to mark in red ink in your mental calendar is April 1st, 2026. That is when it comes into effect.
Okay, April 1st, 2026. But I have to ask the skeptic's question here. Is this just a find and replace job? Did they just take the old rules, change the font, put a fancy new cover page on it, and call it a revolution? Or is the architecture actually different?
The architecture is fundamentally different. And to understand why, you have to understand the problem with the 1961 Act. Imagine a house built in 1961. It was a decent house for its time, but every single year for 60 years, a different architect came in and added something. One added a room, the next one knocked down a wall, the next one added a garage. The next one realized people were sleeping in the garage to avoid rent, so they bricked up the garage door.
And after 60 years, you have a labyrinth. You have staircases that lead to nowhere and windows that open into brick walls.
That is exactly what the Income Tax Act of 1961 became. It had thousands of amendments, provisos, and explanations. It was patched over so many times that it became contradictory. It was heavy, confusing, and arguably the single biggest source of litigation in the country. Half the time, people went to court just to figure out what a sentence meant.
So the new act is the goal to just bulldoze the old house and start fresh.
Pretty much. The new act wipes the slate clean. It is designed to be concise, lucid, and easy to read.
Lucid. That is not a word I usually associate with tax law.
No, me neither. But the goal is that an ordinary citizen, someone who isn't a tax lawyer, should be able to look at the form, look at the rule, and understand their liability without needing a translator. It signals a move toward a trust-based system. The assumption in 1961 was that you were hiding money. The assumption in 2025 is that you want to comply, provided it's not a headache to do so.
I can get behind that. Less friction, more compliance. If you make it easy to pay taxes, more people will probably do it. But let's get into the specifics that hit the wallet. Because while simplification sounds nice, the government still needs revenue. They didn't just simplify, they also tightened the screws in some places. Specifically, they closed a major loophole regarding share buybacks.
Ah, yes, the death of the arbitrage. This is a massive shift for investors.
Break this down for us. Previously, if I held shares in a company, let's say a big IT giant, and they did a buyback, that was generally seen as a good thing for me, right? The stock price usually goes up, and I get cash.
It was excellent for you, and here is why. Companies have two main ways to give their profits back to shareholders. One is dividends, the other is buybacks.
Okay, simple enough?
Dividends are straightforward. The company sends you a check. But here is the problem. Dividends are taxed in your hands at your slab rate. If you are a high earner, and many investors are, you could be paying 30%, maybe even upwards of 39% or 42%, depending on surcharges, on that dividend income. It's expensive.
Right. It hurts to lose 40% of your payout to the government.
But buybacks were different. Until now, the tax on buybacks was paid by the company, not the shareholder. And often, due to the structure of the buyback tax, the effective hit was lower, or at least the shareholder got the full amount tax-free in their hands. It was a classic tax arbitrage.
So companies would sit in board meetings and say, hey, instead of giving our shareholders a taxable dividend that they will hate, let's just buy back their shares so they get the cash tax-free.
Exactly. It was engineered to minimize tax. It was a well-known, perfectly legal strategy. But the finance minister has decided to level the playing field. As of this budget, income from buybacks will be taxed as capital gains in the hands of the shareholder.
Ouch. That is a significant change. So if I sell my shares back to the company, I have to calculate capital gains, my purchase price, minus the sale price, and pay tax on it just like I sold it on the stock market.
Correct. The tax burden shifts from the company to you. But wait, there is a twist. A very specific promoter catch.
I knew there would be a catch. The government isn't just going to let the big fish swim away.
See, the government realized that if they just shifted the tax to the shareholder, the promoters, the founders, and big owners might still find ways to game the system. Often, promoters have a very low cost of acquisition. Maybe they got the shares for pennies when they started the company. So capital gains tax might still be preferable for them compared to dividends.
Right, so their profit margin on the sale is huge, but it still might be taxed less than a straight dividend would be.
Precisely. So to prevent tax avoidance by promoters, they added a layer. Promoters will have to pay an additional buyback tax.
Wait, on top of the capital gains, that sounds punitive.
It's a mechanism to ensure the effective tax rate hits a specific floor. The government did the math. They want to make sure that whether you take money out as a dividend or a buyback, the government gets roughly the same cut. For corporate promoters, the effective tax becomes roughly 22%. For non-corporate promoters, it hits 30%.
Wow, so they really locked the door.
They welded it shut. The message is clear. Choose dividend or choose buyback based on your business needs, capital allocation, stock liquidity. Not because you were trying to save 5% on tax, the arbitrage is dead.
Okay, that's the bad news for the crafty investor who is enjoying those tax-free buybacks. Is there any good news? There is an acronym here that sounds like a sci-fi drive system, FASTDS.
FASTDS, the Foreign Assets of Small Taxpayers Disclosure Scheme. This is actually a massive relief measure, and honestly, for a certain demographic, this is the best news in the budget.
Who is this for? When I hear foreign assets, I think of billionaires with yachts in Monaco or secret Swiss bank accounts.
No, and that's the misconception. This isn't for the billionaires. This is for the accidental criminal.
The accidental criminal, that sounds like a movie title.
Let me paint a picture for you. Imagine you're a software engineer in Pune. You work for a US-based multinational. As part of your bonus, they give you RSUs, restricted stock units. Technically, you now own shares in a foreign company.
Okay, that's very, very common. Millions of people.
Or imagine you were a student doing a master's in London. You opened a bank account there for your stipend. You came back to India, got a job, got busy, and forgot about the account. There's maybe 200 pounds left in it.
I feel called out. I think I have an old checking account in Chicago with $10 in it from a trip years ago.
Well, under the Black Money Act, technically you are in big trouble. The Black Money Undisclosed Foreign Income and Assets Act is incredibly harsh. It was designed to catch money launderers. The penalties for non-disclosure, even of small assets, were draconian. We are talking about penalties of 10 lakh per year and potential prosecution.
For $10, that seems insane.
It was a sledgehammer used to crack a nut. The law didn't distinguish well enough between a money launderer hiding millions and a techie who forgot to declare an ESOP or a student with a dormant account. That fear, the fear of the tax notice, was real. That is what FATIS fixes.
So what is the offer on the table? Is it an amnesty?
It is a one-time amnesty-style window. For a period of 6 months, if you have foreign assets below a certain threshold, specifically focusing on non-immovable assets, so stocks, bank accounts, not villas, you can disclose them now.
And if I do, what's the catch?
You get immunity. And the key phrase here is retrospective immunity.
Meaning they won't dig up the past, they won't ask why I didn't declare it 3 years ago.
Exactly. For non-immovable foreign assets under 20 lakh, the immunity from prosecution is retrospective from October 1st, 2024. It's a clean slate. The government is essentially saying, come clean, we'll wipe the past.
That is huge for the middle class.
Yeah.
It's basically the government saying, look, we know you want a drug lord. Just tell us about the RSUs and the student bank account, and we're cool.
Precisely. It clears the administrative clutter. It allows the tax department to focus their energy on the actual big fish rather than harassing students and software engineers over paperwork errors. It's a win-win.
Moving on to another acronym that gives small business owners nightmares. TDS, tax deducted at source. There is some rationalization here regarding manpower supply. This sounds incredibly dry, but I'm told it's a big deal for the services sector.
It sounds dry, but cash flow is the oxygen of business, and this issue is choking people. Here is the dispute. If you run a security agency or cleaning company and you provide guards to a corporate office, is that professional services or is that contract work?
Why does the label matter?
The tax rate. The TDS rate. Under Section 194J, professional services, the rate is high, often 10%. Under Section 194C, contractors, the rate is low 1% or 2%.
And I'm guessing the tax officers always argued it was professional services.
Of course, because the tax officer's job is to collect revenue. They wanted to collect more tax up front. So a security agency whose profit margins are razor thin, maybe 3% or 4%, was having 10% of their total revenue withheld by the client.
Wait, if my margin is 4% and you take 10% of my revenue, I am cash flow negative.
Exactly. You're deep in the red before you even start. It destroyed their working capital. They had to borrow money just to pay salaries while waiting for a tax refund that might come a year later. It was killing small businesses.
That is brutal.
Yeah.
So what's the verdict in this budget? Is it a service or a contract?
The budget clarifies it once and for all. Supplying manpower is work. It falls under the contractor category.
So the rate is?
Standardized to 1% or 2%.
That is a massive drop. That frees up 8% or 9% of the revenue immediately.
It's a huge injection of liquidity for that sector. It means they don't have to borrow as much working capital. And speaking of easing the pain, they've also introduced an automated process for obtaining a lower or nil deduction certificate.
Oh, I know this pain. If you know you aren't going to owe tax, maybe you are making a loss this year, you have to beg the tax officer not to cut TDS.
And it used to be a manual chase. You file an application, you meet the officer, you explain. Maybe there is some discretion involved, if you catch my drift. Now, it's rule-based. The computer decides. If the system sees you don't owe tax based on your history, it generates the certificate. No human intervention, no delays.
Again, trust-based. I'm seeing the pattern here. Before we leave direct taxes, we have to talk about the corporate side. The MAT.
Minimum alternate tax.
For the uninitiated, this is the tax companies pay when they use so many exemptions that their profit hits zero.
All right.
The government says, not so fast, pay at least something.
Exactly. It's a floor, a safety net for the taxman. The rate has been reduced from 15% to 14%, but the real story isn't the 1% cut. It's that MAT is now proposed to be a final tax.
What does that mean, final tax?
Previously, if you paid MAT, you got a MAT credit. Think of it like a store coupon. You could carry it forward and use it to reduce your tax bill in future years when you made more profit and fell under the normal tax regime.
And now, the coupon machine is broken.
That accumulation stops. MA is the final liability. No more billing up coupons.
Why would they do that? That sounds harsh. It sounds like they're taking away a benefit.
It's a nudge. Actually, it's a shove. The government wants all companies to move to the new tax regime. The new regime has lower corporate rates, but almost no exemptions. MA is a feature of the old regime, the one with all the messy exemptions.
Ah, I see. They are saying if you want to stay in the old complicated system, we are going to make it less attractive.
Exactly. They are even saying you can only use your existing piled-up EMA credit if you switch to the new regime. They are using the credit as a carrot to lure companies into the simplified system. They want to kill the old regime by making it obsolete.
Strategic. Very strategic. Okay, that's the money they're collecting directly from our incomes. Now let's look at the things we buy. Indirect taxes, customs duty.
This is where the budget stops being about accounting and starts being about geopolitics and industrial strategy.
I notice a theme here. It seems like a battle between Make in India and green energy.
It's a balancing act, a really tough one. We have two major national goals. Goal 1, manufacture everything in India. We want the factories, the jobs, the supply chains. Goal 2, transition to green energy rapidly to meet our climate goals.
And those two conflict.
Often, yes. Because to achieve Goal 2, green energy, we need high-tech raw materials and components that we just don't produce yet. So do you tax the imports to protect local miners who are just starting out and are expensive? Or do you make imports free to help the solar manufacturers scale up and make cheap panels?
It's the classic infant industry argument. And what is the verdict? Who wins?
For solar, they chose the downstream manufacturers. Specifically, look at sodium antimonate.
Sodium antimonate. Sounds like something from a chemistry set I wasn't allowed to touch as a kid.
It is a critical chemical input for making solar glass. The duty on this has been slashed from 7.5% to nil.
Zero duty.
Zero. Why? Because we want India to make the glass that goes onto the solar panels. If the glass is cheaper, the panel is cheaper, and solar adoption accelerates. We are prioritizing the finished product, the solar glass, over the raw material protection.
So we are importing the ingredient to cook the meal here.
Correct. But the biggest energy bet isn't solar, it's nuclear.
I saw this. They extended exemptions all the way to 2035.
Yes. Exemptions on goods and machinery required for nuclear power projects are extended to 2035. And crucially, it now covers all nuclear plants, irrespective of capacity.
Why is that date 2035 so important? That's 10 years from now.
Certainty. That is the key word. Building a nuclear plant is not like building a solar farm. A solar farm goes up in 18 months. A nuclear plant takes 10 years to plan, approve, and build. If I'm an investor putting billions into a reactor, I need to know what the tax regime will be in 2032. I can't have the tax rate changing every February. By locking in these breaks for a decade, the government is de-risking the capital.
It signals that the government has accepted that solar and wind aren't enough. They can't provide 2047 power.
Exactly. Solar works when the sun shines, wind works when the wind blows, but for the base load, the power that runs factories at 3 a.m., they are betting the house on nuclear. This tax change is the signal that the nuclear renaissance in India is real, and it's being backed with serious policy.
What about the critical minerals? Everyone is talking about lithium, cobalt, monazite. These are the oil of the 21st century.
The budget reduces duty on monazite to nil. But more importantly, it gives an exemption for capital goods machinery used to process critical minerals.
Connect the dots for us. Why machinery? Why is that the key part?
Right now, the global supply chain is mine in Africa or Australia, ship the dirt to China, refine it in China, and sell the battery-grade chemical to the world. India wants to break that monopoly. We don't just want to dig minerals out of the ground. We want to bring the processing machinery here and do the refining in India. That is where the value addition is. We want to be the refinery, not just the mine.
It's the same story with the microwave ovens, right? I saw that in the electronics section and chuckled.
It sounds funny, but it's significant. We've mastered mobile phone assembly. That's done. We are good at it. Now we are moving to consumer appliances. The exemption on parts for microwave ovens marks a shift. We are deepening the manufacturing ecosystem. It's no longer just high-tech phones, it's everyday white goods.
And the aviation sector. I keep hearing about MRO.
MRO, maintenance, repair, and overhaul. This is a classic example of export of services, even though the service happens here. Currently, if an Indian airline needs a major engine repair, they often fly the empty plane to Sri Lanka, Singapore, or Dubai.
Why? We have engineers, we have hangars, we have space.
We have the talent, but the taxes on the spare parts and the tools were too high. It was cheaper to burn jet fuel to fly the plane out of the country than to pay the customs duty to import the screw to fix it here.
That is ridiculous economic leakage. We are literally flying money out of the country.
And this budget fixes it. Duty exemptions on raw materials for aircraft parts and maintenance tools. The goal is to make India the repair hub of Asia. We want Singapore Airlines sending their planes here for repair, not the other way around.
About time. Before we get to the cheat sheet, there's a little nugget for the small business owner selling online. The e-commerce export cap.
This is a game changer for the artisan in Jaipur or the textile maker in Tirupur. Previously, if you were exporting via courier like DHL or FedEx using e-commerce, there was a value cap. You couldn't send large consignments easily through that channel. You had to go through formal cargo routes, which are complex, require agents, and take time.
And now,
The cap is gone. This courier exports channel is now fully open. This unlocks global markets, Amazon Global, eBay for Indian SMEs. It basically democratizes exports. You can run a global business from a garage in Ludhiana without needing a shipping department.
okay, we covered the heavy lifting, the laws, the buybacks, the nuclear strategy, the customs duties. We have decoded the tax revolution.
Now take a deep breath.
It is time for the revision.
The cheat sheet.
Listener, if you have a notebook, open it. If you're driving, turn down the radio and focus. If you're walking the dog, stop walking. This is the budget cheat sheet. We're going to condense 5 episodes into 2 minutes. I'm going to throw a term at our expert, a term we've covered over this series, and he is going to give you the exam fact or the dinner party insight you need, rapid fire style. Ready?
Born ready.
First up, biopharma shaky tea.
10,000 crore. That's the outlay. The focus is biologics and biomanufacturing. The insight. We are moving from being the pharmacy of the world, which is low-margin generics, to the lab of the world, high-value innovation.
Fiscal deficit, give me the number.
4.3%. That is the target for 2026-27. It is down from 4.4% the previous year. The takeaway. We are sticking to the fiscal prudence path. The government is borrowing less, which keeps inflation down and credit ratings up.
Hard Vistar.
AI for farmers. It stands for using digital public infrastructure to give customized agricultural advice. Think of it as a government-backed ChatGPT for your crops. Retail for rural women. It's a linkage program for self-help groups, SHGs, to sell their products directly. Connect this to the Lakpati Didi initiative. It's about income generation, not just handouts.
Kartavya Pawan.
Symbolism. It's the new seat of the Finance Ministry and Budget Operations, a new building for a new era.
Technology and chips. There was some confusion about a galaxy.
Right, Alec Nanda Galaxy. Ignore it for the budget. That was a December current affair regarding a supercomputer that people are confusing with the budget. The budget term you need is ISM 2.0, India Semiconductor Mission 2.0. This is about the component ecosystem, not just the big fabrication plants.
Okay, one conceptual check. This comes up in exams all the time, and investors get wrong too. Capital account versus current account. Where does the budget money fit?
Think of it like a household. If you take a loan to buy a house, you create a liability, but you also create an asset. That is a capital account transaction. If you spend money on groceries, that doesn't create an asset. That is revenue expenditure. The fiscal deficit we just talked about, that is essentially the borrowing requirement, so it sits squarely in the capital calculation.
Perfect. 4.3% deficit. Capital account. Got it.
And just to lock it in, foreign direct investment, FDI, capital account.
Yeah.
Remittances from your uncle in Dubai, current account.
Boom. There it is.
We have covered a lot of ground today.
We really have. So, expert, looking back at this entire 5-part series, we've seen the vision, the spending, the sectors, and now the taxes. What is the so what for the listener?
The so what is that the rules of the game have changed. This isn't a maintenance budget. When you replace the Income Tax Act of 1961, you are resetting the operating system of the economy. When you lock in nuclear tax breaks until 2035, you are setting the energy strategy for a generation.
So whether you are a student writing an answer on energy security, or a taxpayer wondering about your buybacks, or an investor looking at defense stocks, this budget is your roadmap.
Exactly. The shift is from government doing everything to government facilitating everything. Trust-based tax, private sector in space and nuclear, AI and agriculture. It's a partnership model.
And that brings us to the end of our Simplified UPSC Budget 2026 Masterclass.
It's been a pleasure decoding this with you.
If this deep dive helped you navigate the dense forests of legalese and numbers, if we saved you from reading the 80-page speech yourself, please do us a favor. Hit that join button on our channel. We need your support to keep simplifying the complex.
And we want to hear from you. We talked about two very different visions of the future today. The massive concrete nuclear power push and the distributed digital AI for farmers via Bharat Vistar.
That is the question of the day. Which scheme do you think will transform India the most in the next decade? The nuclear bet or the AI revolution in our villages?
Drop your thoughts in the comments. I'm really curious to see which way the audience leans.
Stay curious, keep learning, and as always,
Jai Hind.
Jai Hind.